Hi, this is Darren L. Johnson, business coach and life guide, here with another less than 10-minute video about a specific aspect of business. I have found that one of the most overlooked yet most powerful tools is the profit and loss statement. There is the customer's perception of how business is doing. There is the owner's story of how the business is doing, and then there's the P&L story of how a business is actually doing, the true story. And if all of the information and data is input correctly, the P&L tells the truest story of how your business is doing. There are two very important documents to learn to read, and one of them is the profit and loss statement, known as the P&L, and the balance sheet. This video will focus on how to read the profit and loss statement. The profit and loss statement tells you a lot about how your business is doing. It can also help you to determine ways that you can go about saving money so that you get to bring more money home. Basically, the P&L statement measures all of your income sources versus all of your business expenses for any given period of time. Why read a profit and loss statement? One of the benefits of reading your profit and loss statement is to compare the current year's income and expenses to those of the previous year. This would indicate if the decisions you're making about your business are helping you to make more money or less money. Another benefit to reading your P&L is that it will let you know whether there is a steady amount of growth in revenue and net income in your business. After reviewing your profit and loss statement, you might end up choosing not to create new products and find new markets, but to focus on how to increase your net income. In other words, spend time marketing new products or other existing products to your existing customer base. And so that's something that you might consider. You might also decide to cut back on certain activities that aren't making as much money, or you may decide not to sell the types of products that are making less money. And here's some other reasons for reading your profit and loss statement every 2 weeks or so. I think it's good to do it every 2 weeks minimally. Some people don't read them but once a quarter. It just depends on what works best for you, but definitely learn how to read them. P&Ls help you to answer the question, how much money am I making? P&Ls help you to compare your projected performance with actual performance. P&Ls help you to compare your performance against industry benchmarks and standards. It also helps you to use past performance trends to form reasonable forecasts for the future of your business. P&Ls help you to show your business growth and financial health over time. P&Ls help you to detect any problems regarding sales, margins, and expenses within a reasonable time so adjustments can be made to recoup losses and decrease expenses. P&Ls help you to provide proof of income if you need a loan or if you're applying for a mortgage. P&Ls help you to calculate your income and expenses when completing and submitting your tax returns. Overall, the P&L is a great tool for helping you to succeed in your business. How do you read a profit and loss statement? Well, here's some things to consider. Generally, your P&L will be broken down into the following categories: sales, gross profit, cost of goods sold, operating expenses, operating profit, other income and expenses, net profit before taxes, and net profit after taxes. And I'm going to briefly explain each of these categories to you. Sales, this is the section that depicts the gross revenues generated from the sale of products and or services, less the returns, which would be cancellations, and allowances, which would be reduction in price for discounts taken by customers. Usually, a profit and loss statement will list each specific customer and how much each paid into the business in terms of revenue. The gross profit represents the amount of direct profit associated with the actual manufacturing of the products or services. It is calculated as sales less the cost of goods sold. It's good for determining how much of a markup you can make on sales. Cost of goods sold represents direct labor, raw materials, inventory purchased, freight in, other materials used, and other costs directly related to the products and services that are sold. Operating expenses include the expenditures your business had in order to operate. Items like rent, utilities, office supplies, some salaries, some labor, and some shipping are the kinds of items that make up operating expenses. And here's an equation that will help you determine your operating profit. Your operating expenses minus your gross profit will equal your operating profit. Other income and expenses represent those items that are unrelated to the day-to-day operating expenses of the business. For example, it could be the buying and or selling of rental property or investments. Other income and expenses could also be interest expense on debt such as loans, interest payments earned on savings, and other types of investment accounts that don't have much at all to do with what your business does. Operating profit plus other income minus other expenses is what gives you your net profit before taxes, also known as NPBT. Your NPBT is the best measure for comparing one business against another, simply because the taxes may vary from state to state. And so, since taxes are deducted from your NPBT, when determining the value of a business, the net profit before taxes is a better measure from one state to another if you're comparing businesses. From your net profit before taxes, you subtract your taxes, and that will give you the net profit. This gives you the bottom line earnings of your business, and it's called net profit after taxes, or NPAT. Your net profit after taxes is the total amount of profits during any specific period of time. The total profit can be a large amount if the business performed well during that period, or it can be a negative number if your business spent more than it brought in revenue during that specific period of time. Let's talk briefly about depreciation. Depreciation results when a company purchases a fixed asset and expenses it over the entire period of its planned use, not just in the year that it's purchased, but for the entire period of its use. This section exists largely for tax purposes, and many businesses must show how the equipment and supplies that they own over the course of a year have diminished in value. And depreciation is a non-cash expense in that the cash flows out when the asset is purchased, but the cost is taken over a period of years depending upon the type of asset. Reading your profit and loss statement is how you can determine the true story of your business. The references used in this video are listed on this screen. And until next time, think differently and be better.